My name is Gorman, and in this episode of Semilla.VC, I sat down with Derek Brooks, head of venture at Flatworld Partners. Derek has a wealth of international experience, including getting a Fulbright in Austria, working as a journalist for Reuters, working at the Treasury Department, and also for private equity at the Abraaj Group, where he worked specifically on the private markets of emerging markets before joining Flatworld Partners. In this episode, we discussed how Flatworld Partners builds their fund of funds and what they look for in their first-time fund managers. His investment in Fazenda Futuro, a Brazilian-based company that develops plant-based substitutes for meat products, which produces for a fraction of the cost of Impossible or Beyond. And what Flatworld Partners looks for in a first-time fund manager. We discussed all this and more in this episode of Semilla.VC.
Derek, could you start by telling the audience a bit more about your work history up to and including your current role at Flatworld Partners?
Great. Well, nice to speak to you, Trip. My work history is pretty varied, and I think you'll see, at least in impact investing in VC, that's not too uncommon. Out of undergrad, I had an interest, particularly in international relations, and started my first job actually in Bosnia and Herzegovina with the OSCE, which is a peacekeeping mission there. And I think very similar to your kind of experiences, Trip, I found the work to be very interesting, but very much the pace and kind of the rate of change and your personal kind of impact on work to be very slow. And kind of my kind of first foray into international relations. I actually had a Fulbright lined up immediately after that in Austria, actually from the Austrian American Education Commission. So continue kind of in international work, teaching at 2 high schools in Austria over 2 years. Worked as a journalist covering Eastern Europe, particularly looking at financial markets and insurance. But that was all really to kind of continue to build like a bigger picture of the world. And I loved investigating. I loved the process of writing. But journalism also was not for me. In that meantime, ended up going to grad school for international relations and economic development, Johns Hopkins SAIS. And that's actually what really kind of spurred me on to thinking about private sector development in emerging markets and looking at the way the private capital could both increase the rate of innovation, also basically transfer of technology and goods and services to a variety of countries and contexts, but also really have a personal impact through through working in finance, where you can have much of our hands on. So that actually led to really my first job in finance, which was with the Abraaj Group. Abraaj at the time was the largest emerging markets private capital organization, 16 billion AUM, based in Dubai. I was very happy to get this job. It was really the perfect place to end up really a emerging markets focused private investment manager based in emerging markets, right? So really not this whole idea of a fly in, fly out model, but really, besides me and of course a handful of other people, the employees would reflect the markets that we invest in. So felt incredibly privileged. I had a very central role there, kind of on the central strategy team in the CEO's office, and really gave me a broad perspective on private equity, venture capital, and really some of the differences that you'd see in investing in Latin America, Asia, Africa, Middle East than you would maybe in the US context. Story of Abraaj, I think, is very public. Obviously that ended and has its own lessons on kind of in some of the pitfalls of emerging markets, finance, in terms of regulatory oversight and kind of other governance issues. But one of my main takeaways there is really the importance of, in any kind of new technology or state of change, is thinking about kind of the social and environmental determinants of what you do outside of creating value through investments. And kind of this focus on ESG and impact also kind of became core what I did. So after Abraaj, I decided to refocus, not just on emerging markets, but thinking about impact and sustainability in a greater context. So that brought me to Flat World, where I am now today. And Flat World Partners is a impact investing advisory firm. We do a couple of things, but one is advise LPs on investments into private equity funds, venture capital funds, private debt funds that have both commercial returns, but also measurable or clearly defined impact sustainability agendas and outcomes. So we do that here. I invest across private equity and venture capital as an LP. And on the platform as well, we continue to invest directly into companies, which is what I lead on the platform. And that can be across stages of venture capital, Series C to Series C, Series C to Series C. And that's across emerging markets, developed markets, climate, health, and social inclusion. So that's kind of the basis of my work and my journey and career so far.
Could you tell the audience a bit more about your investment in Brazil-based Fazenda Futuro?
Yeah, so as an advisory firm, we've developed different ways to become active in our investment advice. So one of our clients is a Brazilian multifamily office, which we work together to that fund can also make direct investments. So within that context, our work with this Brazil vehicle has had a focus on healthcare, climate, and education. And as we looked through direct investments, we found that we had privileged access to Fazenda Futuro in their series, I think it was their Series B round at the time. Now, what Fazenda is and what made it a very attractive investment for us was, well, first of all, the LPs in this fund were Brazil, already had an understanding and risk appetite for Brazil. But we were also seeing the trend of moving to plant-based food in the US actually accelerating across Latin America, both in Brazil, Argentina, Chile, mostly among the upper middle class and above, but also kind of some of changing values and behaviors of consumption. However, if you look at an Impossible Burger or a Beyond Burger, right, the relative purchasing cost is very expensive, right? It's not at price parity with meat. So what's really attractive about Fazenda Futuro is they were in Brazil creating a domestic plant-based burger, probably tasting better than Beyond, but not as good as Impossible. However, at maybe 1/4 of the cost of a Beyond Burger, right? So domestically produced. And if you think about it, one of the main inputs in all these plant-based is soy. Brazil is one of the largest producers of soy. Instead of importing soy into the US to be produced into meat and re-exported, better to produce that in-house. Furthermore, we can think about all the sustainability challenges with soy, but having a producer based in Brazil focus on the Brazilian market and export actually gave them much more deeper clarity in finding sustainable soy farms, right? Soy that was not coming from deforested land, soy that was using best practices. And once you have these kind of lower inputs and pretty much a more kind of sustainable supply chain, not only can you sell domestically in Brazil, which has a huge growing population of people that are looking to consume both for health reasons and for environmental reasons, plant-based protein, you can start exporting these burgers and other meat alternatives to Europe, right? Where there is already privileged contracts that allow for agricultural export, which it still is when it's uncooked. Europe doesn't allow for GMO, so it's also a non-GMO product. That's why it's not as tasty, maybe as as I would say, is Impossible, but still kind of better than that Beyond. So we found that to be a very unique value proposition, and given the strategic backing of the LPs in that fund, we were able to get access and recommend and make an investment in Fazenda, and it's gone very well. In fact, they've come to the US as Future Farm.
I love that. I love that. How do you go about building a strong fund of funds?
So, from a idea of fund of funds, right? You have to look at what is the value of a fund of funds, right? So let's look at the kind of the negatives of a fund of funds. So you're investing in other venture capital, private equity funds. Venture capital and private equity funds charge a management fee. If you are creating essentially a venture fund, which has a fee structure that has costs to invest in other funds, you are kind of layering fees on fees. So that's the original danger. So why would someone invest in a fund of fund? Well, it's usually to write a single check, but get access to a more diversified pool on either venture investments or, in our case, impact investments. So when you're thinking about building a venture fund, you got to think about, in this case, what are value you're trying to provide. So if it is a single ticket to access a diversified pool of capital, that's what we have to provide. So when we've thought about construction in fund of funds, you think about investing across actually multiple themes. So in the case of the Purpose Fund, right, is investing across climate, health, and education. So already giving those LPs access to a broad range of diversified. We are also thinking about stage, right? So we want to have maybe, a third in venture, maybe a third in growth, and third in private equity. So once again, they're writing a single ticket and getting a diversified pool of private investments. So in that vein, right, as you are providing value to those LPs, you also want to make sure that you're niche, right, that they're not already getting that access to their other private equity or venture exposure. And so, but from our perspective, since we were investing in impact fund, this was a way for LPs to access impact in a diversified sense and learn more really about funds. It's a kind of a learning opportunity. And either they can continue investing in a fund of fund as it gets bigger, more diversified, or use that learning to go and make their own LP commitments. That's part of the catalytic part. But that's when we think about fund of funds. The other thing you have to realize, right, is you have a narrower window to invest. Funds have 10-year life cycles, right, already. So if you have to have actually quite a few investments in a compressed amount of time, and then probably raise subsequent vintages, since you're not going to have fund one and fund two of random education fund in the same fund, right? You're going to invest in only one vintage at a time. And then, right, you have on top of that, their 10-year life cycle to prove that return capability. So it's, fund of funds have gone out of fashion for a while. I think they're coming back, especially with the proliferation of venture funds that are out there. And so you have to think also that the value of a fund of funds is maybe getting access to a fund, like a very well-named brand fund, that doesn't want to take small LP checks. That could be a value prop. The other value prop is there's just so many small funds out there that an LP doesn't have time to make individual investments. So to bring a lot of those in-house.
So Flat World Partners works with multifamily offices, family offices, and other institutional investors. Where are these clients primarily based, and what's the profile of the ideal Flat World Partners client?
So I would say the majority of our clients are now US based. We do have international clients in Brazil and Europe. But I think for us, where we found kind of the best alignment, right, has been in endowments or pools of capital that have maybe a front end, either a grant making arm or a business or kind of a family history, that they really want to align their investment dollars with their philanthropic or purpose, or business purpose on the other side. So let's say that you are a foundation that is focused on low income, giving grants to low income individuals on your grant making side. But you have an endowment, which, right, is looking for commercial returns to return capital so you can make that. Well, a lot of times you really want to see your dollars on the investment side should be generally more reflecting the values on your grant making side, right? You can even catalyze your impact greater. So we find those clients are very helpful, and we worked with numerous of them to define that impact objective on the fund side. And now not everything is investable. Not every idea is an investable idea. Some things are philanthropy. We don't help with that, but we can align to make sure that those values reflect both sides. So we find that's really kind of the ideal client. But then generally, right, we're seeing a lot of people trying to align, maybe not so specifically with certain mission, but in a general sense, wanting to have a portfolio that reflects just general best-in-class ESG and impact. And we can also build that as well, which is even easier, right? Because then you can start investing across sectors, private equity and venture, across healthcare, environment, affordable housing, real estate, et cetera.
Flatworld is an impact investor, and you mentioned that it's only measurable impact. How does Flatworld measure the impact of the initiatives and investments?
So there's two things there. One is we don't have to, because we require the funds we invest to do it. But we definitely try to work with funds to figure out what is the best way for them to both track their impact, also track the negative externalities, and kind of really build their own system. So we expect that of the funds that we work with, and we analyze that as part of our due diligence. And there's multiple ways to do it. I think in climate, right, tends to be a little easier, though not exclusively, right? We can have some sort of universal measure, which could be carbon, how much carbon is avoided or offset. It's something that's very tangible, numerical, of course, not the only thing you can invest in, but that tends to be right a gold standard. On the social side, it becomes a little trickier. And I think we've actually struggled to think about it, and we've seen funds struggle to think about it in the US context. In emerging market context, sometimes the social impact is a little clearer, right? If we can think about hospital beds added in general, right? And hospital beds added to kind of certain income threshold individuals, right? That's a measurable impact on health. In the US, it's a little more challenging since we have a much more, I would say, right, developed healthcare system. So we look for ways to think about how are more vulnerable populations being included. And we work with funds to help develop that. On our own direct investments, we look for kind of minimal viable, right? In the end, you can't ask startups to give you too much data, right? They are dealing with quite a lot of data requests, and we're usually a small investor in the capital. So we're looking for what KPIs attached to the business can also tell us that they're continuing with the mission that we underwrote them for. And an example is we are in the process right now of investing in an African health tech startup that is focused on digitizing medical records, right? It's a little challenging. How do you think? The impact is really clear if you think about a thought experiment, but what are we really measuring? So, that's something that we are, have to develop, and we kind of set at the beginning and look for these data points, and then also look for data points that would tell us that there's drift in mission, and that we would report back to our LPs. I think the key, though, is to use some process standards. We're signatories of the operating principles of impact measurement. We analyze funds based on that. We like to align deals and funds to the SDGs, which are not perfect, but give you an outset that if a fund is investing in those themes, that they are moving in the area of impact. And then we look at the impact management, IMP, impact management project, as a framework of how to both measure and capture data.
How has the recent market downturn affected Flatworld Partners with investments and the relationships and projects that you guys are spearheading with your clients?
On the direct investment side, I've noticed flat rounds. I'm investing right now in a deal that is essentially a flat round. So it's actually not a too bad place to be if you are looking to invest. I think probably investors should not be too shy, but also should be cautious. We don't know how, we actually don't know if we're approaching a recession or not right now. Probably might be, but to be honest, I don't think even the experts can really tell us at these points, since economics has gotten quite convoluted. So that's one point. And for us as well, on the advisory side, our clients have the luxury of not investing when they don't want. So We did take a quite little bit of a pause, as we look at funds, but we're still going forward and recommending those that we think are strong. And quite honestly, funds that have capital now are probably in a good spot to invest. It's also probably meant that we are very cautious when we look at track records of venture managers that we've invested in or investing in. Maybe some of those write-ups are not as strong as they look. So we've definitely taken a more conservative approach in the way that we are analyzing funds, but I don't think anything has fundamentally changed too much.
Even before the market downturn, did Flat World ever invest in first-time fund managers?
Yes. Look, it's not our mission to invest in first-time fund managers. However, it is our mission to invest in changing technologies. And we're seeing a lot of first-time fund managers come through that are providing unique value propositions. Now, just because they're first-time fund managers doesn't mean they're first-time investors, right? You want to invest with people that really know what they're doing, and that's our perspective. But we've found ways to look at alternative track records, whether it's what they were doing before, startups they were working in, or 360 views on the GPs. We also have a mandate to take another look at the diversity of the managers that we invest in. We are not going to invest in a manager just because they're diverse, but we are investing in diversity as a theme on the impact on portfolio companies, so the founders of portfolio companies, but also the populations they serve. So if you want to serve diverse populations with healthcare, financial inclusion, you probably should have diverse CEOs and founding teams, which probably means you need to have diverse VCs to be able to find those, right? It's really a whole chain. It's kind of three really important themes. So we are finding really interesting managers who are first-time managers and are diverse, investing in diverse founders who invest for the benefit of diverse populations. And we are finding strong investors that way, but not at all just because they're diverse, but because that they have some alternative perspective that they've been able to build in their track records or experiences.
One last follow-up, and then I'll stop chiding you on that answer you gave. What would be an example of a unique angle or perspective that would, make Flat World quite interested in investing in a fund?
Yeah. So I'll give an example. We recently recommended a fund that focuses on Medicare and Medicaid populations. Now, this was actually a fund 3, but even fund 3s are pretty junior, and we thought this was a really interesting perspective. You do not see a lot of people in health tech focusing on the bottom of the pyramid in healthcare, right? There's a little bit of trickle down speak that, like, if you invest in general healthcare, we're going to lower costs, increase outcomes, which benefits everybody, but very specifically targeted at Medicare, Medicaid, and vulnerable populations. We thought that was a unique perspective. However, right, even at a fund 3, fund 1's not exited, and fund 2 is still in J curve. There's not a lot of data that can really see. So we looked at those deals, looked really deeply at the backgrounds through interviews and histories to get comfortable with the fund. We also recently backed a fund that had a unique perspective on financing. So instead of just looking at venture as something that needs 100x equity deals, you can think about a variety of companies that are starting that maybe are 2 or 3x's or 4x's, or even if they are, they're going to be $50 million companies. And maybe their exit doesn't need to be a sale. So this fund had a unique way of financing, basically through debt instruments that didn't take ownership away from these companies and really focused on minority-owned businesses. You can think of a roll-up of hair salons. You can think of like a variety of kind of new startups, some tech-enabled, maybe some less, that you can actually give more debt-based financing to and preserve ownership, and not necessarily expecting rocket ship growth, but still steady growth and a way to capitalize in. And that was a unique fund. That was a first-time fund as well, actually an actual first-time fund. So those are kind of the examples of things that we've found unique in the market that were worth, taking a risk despite maybe not a, fund 7, fund 5 track record.
Okay, finally, I have to ask Peter Thiel's famous contrarian question, but with uniquely Semilla.VC twist. What important truth about emerging markets at large, or specifically at Latin America, do very few people agree with you on?
Very few people agree with me on. I think that this is going to be not very technical, but very strange. Is emerging markets a growth story or a trade story? And, a lot of people will bet just for the growth. But I think that's really short-sighted. You have to look at the trade. I think valuations still incredibly matter. You still have a very difficult exit environment. So really, it's not just, I would say in private equity, EBITDA growth that you need to go for. It's really multiple exchanges, buy low and sell high, and having to create value. And I think a more active approach in emerging markets is important when you're thinking about yourself as a manager. If you have an exit opportunity, exit when you can. Still be on that growth story, but it may be a lot longer than the typical VC 10-year life cycle. So as I say, trade, buy low, sell high. It sounds very silly, but we can believe in emerging markets growth, but at the same time, we have to be very practical on what value you bring to your LPs and exit when you can.
What an answer. Derek, thank you so much for taking the time to come on the Semilla.VC podcast today.
Really great work that you're doing, Trip, and good luck with your endeavors in Latin America.
There we go. I appreciate the comment. Thank you.
Thank you for watching this episode of Semilla.VC. My name is Trip Gorman. Don't forget to like and subscribe wherever you view the podcast, as well as check out our weekly newsletter, Dealflow LA, which can be found by going to dealflow.la. Thank you.